But to your bank account, are you calculating how much higher your mortgage repayments will be now that Westpac, ANZ and the Commonwealth Bank have raised their home loan interest rates? Martin North is the principal of Digital Finance Analytics. Morning, Martin.
Hello.
Why have these banks raised their rates when there's been no move from the Reserve Bank?
That's a good question, but it's to do with the international costs of funds. So banks fund their books partly from overseas. The US have been putting their Fed funds rate up. That's flown through to the capital markets, and therefore the banks now are having to pay more for that funding. They've been sitting on that for a few months, but their net interest margins have been nibbled away, and so rather than effectively giving lower profits to shareholders, they're now trying to claw it back from mortgage holders.
Did they sit on it because it would have been a bad look to raise rates during the Banking Royal Commission?
Well, I think that's absolutely right. I mean, the banks are on the nose, left, right and centre, and the last thing they wanted to do was to, exacerbate the situation. I think perhaps also they were hoping that maybe the funding costs would come back, but of course they've stayed and are still rising. So they also, I probably picked a time when, of course, the GDP number came out, and so everyone was saying, oh, well, it can't be too bad then. So maybe there was a timing aligned to that as well.
No one wants to be first, though, do they? It's waiting to see what another bank does, and then if they put it up, the other banks go, oh, well, maybe we can too. Is that how it works?
Well, it's really interesting because, of course, Westpac was the first one to do it last Friday, right? And then there was a bit of a pause. And then ANZ, and then within 5 minutes, CBA followed. So you'd assume NAB will probably follow as well. So there's a lot of watching over their shoulders and seeing what their other competitors are doing. They're all, of course, sitting on the same funding problem. So in a way, nobody wants to blink first. So in this case, Westpac blinked first.
You say they want to protect their profits for shareholders, but when you see profit figures of billions of dollars, mortgage holders might say, well, come on, guys, can't you absorb it for a little bit longer? Is it unfair that the banks move in your mind, Martin, or is it all fair play when it comes to the commercial realities of the situation?
Well, let's face it, banks are commercial entities. They're there to maximise the profits for their shareholders. Unfortunately, I think that the Royal Commission has shown that they skated too close to the wind in terms of maybe even breaking the law in places and frankly, probably putting profit first. I think there's a lack of balance between profit for shareholders and supporting the community and, recognising that the customer base is absolutely critical. So, to my mind, there was always a question of whether one of the big majors will actually break away from what's been happening. But at the moment, it's same old, so shareholders come first.
By the banks increasing theirs out of sync with the Reserve Bank, does it put more pressure on the RBA to keep their official cash rate on hold even further?
Well, of course, anything that puts further pressure on households because debt's so high in Australia is a concern to the RBA, firstly because we know that more households may well fall over, we might talk about it in a second, but also, of course, households, if they're spending more on the mortgages, are having to spend less in the shops, and therefore there's an economic impact as well. So anything that the Reserve Bank might have been thinking about in terms of trying to normalise rates from the ultra-low levels now to something more realistic has probably been put further out simply because of what the banks have been doing. And in fact, I still think that the Reserve Bank may be forced to drop rates rather than lift rates, not immediately, but ahead.
Martin North is from Digital Finance Analytics, taking a look at your mortgage this morning. So Westpac's up 14 basis points, ANZ up 16, CBA up 15 basis points. How will those rate rises impact the average home loan?
Well, let's say you've got a $300,000 home loan. That's pretty average around the place. That's around $35 extra a month if that flows all through, as it probably will. It's going to hit in the next, 2 or 3 weeks, depending on exactly which bank we're talking about. Obviously, if you've got a bigger mortgage, then the monthly impost is even higher.
Could you estimate how many more homeowners in Brisbane then will experience mortgage stress as a result of a bump like that?
Yeah, so we've just updated our modelling, in fact, and if you look across the whole of Brisbane and Moreton Bay, firstly, so if you like that whole regional area, right, we've got about 135,000 households out of about 480,000 who are experiencing mortgage stress currently. Now, as these rates come through, that moves up to about 145 to 150,000 households. So the point there is stress is about cash flow, so money in, money out. And what's happening is that more and more households are finding that they're just not able to keep their heads above water, and so they're raiding deposits, they're putting more on credit cards or just hunkering down. But ultimately, that translates potentially to defaults for some later. And so, for example, across that broader area, we've got about 7,500 looking as though they could default in the next year. But now I'm going to increase that up to nearly 8,000. So extra 500 households potentially risking default over the next year thanks to these changes.
And you're saying that in Brisbane alone, Martin?
That's sort of Brisbane and Moreton Bay, so that whole area. If you then come into the Brisbane locale and then look at a few particular postcodes, the one I'm most concerned about in Brisbane itself is places like Bellwood Park, for example, right?
Yep.
And there we're looking at there's about 3,200 who are in stress out of about 8,000 there, and around 121 or 2 looking to risk and default. But that could go up to about 130 to 135. So that's a very sensitive postcode. And what's interesting about that one is we call that our suburban mainstream. So this is mainstream Australia. This isn't the battlers necessarily. These are people who are actually in the perhaps even some of the more leafy areas. And then the next on the list in Brisbane itself, where we go out to places like Everton Park and Everton Hills, places like that, Stafford Heights. And there we've got just over 100 who are risking default, but now I'm going to put that up to about 110. So, these are not big numbers, but they're incrementally significant, and that's the problem. This is a long-term structural thing we have, and there are others in the Brisbane area that are also equally affected.
Martin, really appreciate you chatting today, even though it's not great news. Thanks so much for your time.
Good to talk to you.
Martin North, who is the principal of Digital Finance Analytics.